because they do. In fact, they might matter more now than at any other point in this decade. When you look at what's happening in the world today, the first thing you must understand is that none of it is random. Things don't just happen. They follow patterns, long-term forces that have repeated throughout history. And once you learn to see these patterns, you begin to realize that the world is driven more by systems and cycles than by individual events. Most people react to the event. Very few understand the system behind it. And that difference determines who stays prepared and who gets blindsided. Every major shift in markets, currencies, or societies begins slowly, almost invisibly. The early stages of a cycle are always quiet. Debt builds gradually. Confidence weakens quietly. Production tightens without making headlines. People see the symptoms, but not the underlying machine. But when the pressures inside that machine reach a breaking point, the shift happens suddenly. It feels like an earthquake, not because it arrived unexpectedly, but because people weren't paying attention to the long-term forces that created it. Throughout history, economies move like clockwork, rising productivity, growing debt, expanding credit, then tightening, deleveraging, and rebalancing. These cycles are not my opinion. They've repeated for hundreds of years in every major country. And they're repeating again now. When debt rises faster than income, when governments finance spending by creating more money, when currency loses purchasing power, system naturally shifts toward real assets. That's a pattern you see across centuries. And although the faces, the headlines, and the governments change, the underlying mechanics remain the same. To understand the moment we are in right now, you have to zoom out, stop watching the daily price ticks, and start studying the long arc of history. The forces that move silver or any real asset are not short-term emotions. They are long-term imbalances. They are structural. When debt expands, money printing increases, and supply chains weaken, you get pressure on the financial system. And when those pressures rise, people seek things that cannot be printed, inflated, or manufactured out of thin air. This is why real assets become important in late cycle environments. Now, every cycle also has internal contradictions. For example, governments need money to sustain their obligations, but raising taxes is unpopular and cutting spending is politically costly. So what do? They borrow more. And when borrowing becomes too expensive, they print more. Has happened dozens of times in history in China, in Europe, in the US, in ancient empires. When a system relies on too much debt, it eventually requires a rebalancing. And that rebalancing almost always leads to currency weakening and real assets strengthening. What makes this cycle unique is that global forces are converging at the same time. We see rising geopolitical tensions, supply constraints, demographic pressures, and technological demands that require materials like silver in large quantities. So you have financial pressure from above and physical scarcity from below. That combination is rare, and it creates an environment where traditional assets may struggle while real-world assets gain importance. Again, not because of emotion, because of structure, because of how the machine works. Small investors often think they are too insignificant to matter. But cycles don't care how big or small you are. They affect everyone. What does matter is whether you understand them. Because when you grasp how systems behave, you stop making decisions based on fear or hope. You start making them based on probabilities, incentives, and long-term cause and effect. You begin to see that every major move in markets has roots that were visible long before the outcome arrived. This is why studying systems and cycles is so valuable. It gives you clarity when others feel confusion. It gives you patience when others panic. It gives you conviction when others doubt. And most importantly, it allows you to position yourself ahead of the transitions rather than behind them. What we're witnessing today isn't a surprise to anyone who has looked at history. Late stage debt cycles, declining trust in currencies, rising demand for hard assets, and tightening supply are the classic signs of a system entering its next phase. Ignoring these signals doesn't stop the cycle. It just leaves you unprepared for it. Recognizing where we are in the cycle doesn't tell you the exact day something will happen, but it does tell you the direction we're moving, the risks building beneath the surface, and the opportunities that emerge when the system shifts. And in times like these, understanding the machine is not just helpful, it's essential. One of the most misunderstood concepts in investing is how powerful asymmetry can be. People often assume that great results require great risk, or that large opportunities only belong to those with large amounts of capital. But history shows something very different. The greatest advantages often come from situations where the downside is limited and the upside is disproportionately large. And these opportunities rarely announce themselves loudly. Instead, they appear quietly, usually in places where most people aren't paying attention. Asymmetry is about recognizing an imbalance between risk and reward, about understanding that in certain environments, a small, well-placed decision can produce results far larger than its initial size. Most investors miss these moments because they're trained to think linearly. They assume that what they put in must be proportional to what they get out. But markets don't work like that. Systems don't move in straight lines. They shift, break, reset, and reprice in ways that are often non-linear. And when a system becomes stretched or misaligned, that's where asymmetry appears. Small investors often underestimate their own potential because they believe they need size to make a difference. But asymmetry doesn't care about size. It cares about positioning. A small position in a mispriced asset during a structural imbalance can have an outsized impact. The key is recognizing when those imbalances exist. And right now, they exist in several places where real assets are undervalued relative to financial assets, where demand is rising faster than supply, and where the long-term fundamentals aren't reflected in the short-term price. What creates asymmetry is usually a combination of neglect and mispricing. When something is ignored, dismissed, or misunderstood, price tends to reflect that indifference. But the underlying reality doesn't disappear just because the market overlooks it. In many cases, that ignorance creates opportunity. And when the broader system wakes up to the true value or to the risks building underneath, the price doesn't adjust slowly. It adjusts quickly, sometimes violently, to reflect the new reality. Those moves are where asymmetry lies. Look at how markets behave during transitions. Early in a cycle, when things appear stable, most people crowd into the same assets. They chase what's been working. They assume tomorrow will look like